I'm Alex Davies, founder of Wealth Club. Today I'm with Chris Hutchinson of Unicorn Asset Management. Hello, Chris.
Hello, Alex.
First, can you just tell me a little bit about Unicorn and yourself?
Yes, of course. Unicorn Asset Management is an independently owned specialist fund manager, UK equity investing only. We have a small range of open-ended funds, a large AIM-focused venture capital trust, and an AIM IHT portfolio service. The business is very much long-term in nature, and I suppose one of the things I would say is that the team invest very much in the funds that we manage, so that there is we can ensure alignment of interest, and I think that's really important in everything we do, and we look for that in all of the companies that we invest in. Where the management teams hold a meaningful equity stake, we tend to find that they manage their businesses prudently and try and avoid excess risk. So the business is unashamedly old-fashioned, and we've been around almost 20 years now. I've been at Unicorn for the last 13 years. Before that, I was at a similar investment house for another 8 years, and prior to that, I've done all sorts of different things, Alex. So.
And the AIM IHT portfolio service, what's it all about? How much is in it? What's the reason to invest?
It is a natural extension to what we do in the VCT. I've been looking after the AIM Focus VCT for the last 13 years since I joined Unicorn. We only launched the AIM Inheritance Tax Service at the back end of 2015, so it hasn't been around an awful long time, and it's pretty small. We have two distinct portfolios. One is more focused on capital growth, and the other one is very much focused on income and value. In total, there's about 30 million in the two strategies. I think it's important to manage the size of these types of service, because there is a risk that if you get too big, you're forced up the market cap scale and everyone then ends up owning exactly the same thing. So we like to believe that we're highly differentiated, and it's very much a bespoke, tailored service for individuals looking for some inheritance tax mitigation.
So can you give me a flavour of some of the companies you're invested in, and sort of what are you looking for in the different companies?
Yeah, well, in fact, I mean, in both portfolios, the growth and the income, we hold 30 stocks in each. The income fund is trading at really quite attractive levels of valuation, with again an attractive yield nudging towards 4%. And with the growth portfolio, a collection of higher growth businesses. Obviously, that tends to come with a certain amount of additional risk and a bit more volatility. And of course, one has to accept that one will be paying a bit more for ownership of those high growth businesses. But to give you a flavour, in the growth portfolio, we've got a business called Traxis, which is a couple of 100 million in size today, and is very much a specialist in software and hardware for the transportation industry. It's a business that I invested in first in our VCT, and that's a very important point, because when we first invested, it was a very small business with no more than half a dozen employees. It has grown substantially in the last 10 years since it first listed on AIM, and is now highly profitable, very cash generative, sits with significant levels of cash on the balance sheet, and is expanding into all sorts of related areas. So traditionally, it offered software for optimizing the train operating companies, making sure that the staff manning those trains were in the right place at the right time. Highly complex in terms of rostering of staff on the train network, have saved their customers millions over the years, and therefore it's a must-have type of software. They've gone into hardware with remote condition monitoring of things like signals and overhead power lines for the train companies. They're expanding internationally, and they've got a thriving third leg to the business now, which also measures footfall in events and shopping malls and areas where people need to know what is happening. So the highways agency use them for measuring traffic flows, and typically these are very fragmented markets, and what they've extremely successfully done is started to consolidate and also provide solutions that are really effective both from a cost point of view but also improving operational efficiency. And it's the kind of business that we absolutely love because the founder of the business is still with it. He is a substantial shareholder, a chap called John MacArthur. I've known him for many years now, and we see him at least twice a year when they report. And the fascinating thing for me is that his focus from the outset has been on the long term. And he's not all about trying to issue ever increasing amounts of equity in order to fund highly priced acquisitions to generate this acquisitive growth. It's based on strong organic growth, expanding into many different international territories now, and barely scratching the surface of a lot of that market. So I'm very enthusiastic about that sort of business because we can get to know and understand them at a very early stage within the VCT structure. And then when we're confident in their ability to deliver those strong numbers on a consistent basis, then we'll own them in the IHT.
So once they get to the IHT, so what sort of typical size are they market cap?
Good question. We are very much focused at the smaller end of the market. The growth portfolio is currently 450 million average market cap. The income portfolio is around 280 million average market size for those individual companies. So we're very much focused on the earlier stage, smaller businesses rather than the big multi-billion pound stocks on AIM that everyone knows, the ASOSs, the Fever Trees. We don't own those types of businesses.
Do you sell many things, or what's your turnover like?
We always pride ourselves on doing our due diligence up front and trying to get to know and understand these businesses really well before making the investment decision. It's worth pointing out that in both of these portfolios, the growth and the income portfolio, all of them are profitable at the point of investment. The vast majority of the companies in the growth portfolio pay dividends. 27 out of 30 pay dividends. In the income fund, all 30 pay dividends. And so what we're trying to do is mitigate the risk. And to address your question, when Warren Buffett's asked about when's a good time to sell a stock, he says, well, if you've got a stake in a decent business, then the answer is probably never. So we're not driven so much by valuation as a sell discipline. What we will do is if a company is not meeting our expectations on a regular basis, clearly we'd find it very difficult to continue holding that stake, and then we would sell.
And how risky is all of this?
There's a lot of conversations about the level of risk. I would argue that if you are really sticking to fundamentals, if you're looking for the basics, a proper business that sells products and services that deliver a tangible benefit to their customers, where they're profitable at the point of investment, where they're capable of paying and sustaining a growing level of dividends, where they're generating free cash flow, where they're not overly geared in terms of the level of debt on the balance sheet. Those types of businesses, there aren't hundreds of them on AIM. Clearly, there are about 900 odd companies listed on AIM. Many of those are loss-making. Many of them are highly volatile in terms of the sectors they operate in, highly cyclical type businesses. But within that, you can find probably a potential universe of 100 to 150 stocks, really high quality, consistently profitable, growing nicely, and at a sensible price in terms of valuation. And it's really that we're trying to identify all the time. And I do keep emphasising the fact that our venture capital trust puts us in a very good position to be able to do that, because clearly those businesses are very early stage, often loss-making now, and it takes some time for the confidence to build in the business model and the management teams. But we get to know them very well within a very sheltered environment in a venture capital trust, and then can select the best of those for inclusion in the inheritance tax portfolios.
So if I was going to tell someone to invest in an AIM ISA, for instance, this tax year, can you just tell me 30 seconds or so why they should invest with you?
I think we are very cautious. We're extremely risk averse. We take a long-term view. We're all bombarded these days with massive information overload, and it seems to me short-termism is a major feature of the market. We are effectively trying to swim against the tide. We'll partner with those businesses, especially where the management teams or the family members or founders have retained a really meaningful equity stake in their business. And I could point to a number of companies where a decade or so on from their first listing on AIM, they still own between 10 and 30% of the businesses that we've got a stake in. And that's a powerful thing. You feel you become very confident that they're not going to take unnecessary risks. So for us, it's traditional. Some might say old-fashioned. I don't have a problem with that. I think it's there's too much short-termism in the market, and that's one of the main things for us is that we intend to deliver superior returns over long-term holding periods by investing in high-quality businesses.
Chris Hutchinson of Unicorn, thank you very much.
Thanks very much, Alex.